Hey everybody, this is Mike back again looking at more ratios. You'll notice up on the screen I've got the exact same income statement and balance sheet from the appendix in your textbook, but instead of the profitability and leverage ratios up on the screen, now I have the liquidity and efficiency ratios. So these are the next couple chapters in the book. Anyway, so I'm just going to kind of walk you through the same process. Again, we use all these for the same purpose, for comparing the business against other businesses and comparing the business against itself in previous periods. Also, I'll let you know that a lot of these ratios are used by financial businesses like banks and lending companies as they're deciding whether or not to loan money to a business. Anyway, so let me jump into the liquidity ratios. Liquidity simply refers to how usable a business's assets are, how easily convertible into cash they are. It's not very often we can pay for things in cows or pay for things even in cars or something like that. It's people like cash, and so we need to have our business cash ready. And so that's what liquidity ratios measure is, can we turn our assets into cash and use them? Do we have usable assets, I guess would be a better way of putting that. So the current ratio is what it sounds like. It's the currents. It's current assets divided by current liabilities. So I'll show you. So for 2012, our current assets would be our total current assets of 2750 divided by our total current liabilities of 1174, or 2.34. What does that mean? It means our current assets are 2.34 times greater than our current liabilities. If you think about it, our current liabilities are our debts coming due within the next year, usually within the next operating cycle of the company. And our current assets are those assets, including cash and accounts receivable, inventory, that we're going to have to pay those debts. So we would like for our current ratio to be as big as possible within reason. Usually a lender likes to see a current ratio of 2 before they'll even talk to you. And most business owners I know say if I had a current ratio of 2, I wouldn't be at the lender. I wouldn't need to borrow money. I would just have the money I need. But therein lies the problem with lending in general, right? Usually the people who need the money don't qualify to get it, and those who don't need the money do qualify. Anyway, so there's the current ratio. This company has a 2.34, which is probably pretty good. Again, we'd have to compare it against other similar businesses and see if that's a normal current ratio or if that's high or low for their business. Higher is better on current ratio. Quick ratio is a little different. It's similar but a little different. In essence, what they're saying is certain current assets don't really get used for paying bills, but instead they get used in other aspects of the business. Inventory, for example, whenever we sell inventory, we have to take the money we make to buy more inventory. So there's a certain small amount that we make on that inventory that will apply toward us paying our bills, but most of it needs to be put right back into inventory. So for the purposes of this book, they want current assets minus inventory divided by current liabilities. Other books I've seen define it as current assets minus inventory and prepaid items, but there's no prepaid items in this book. Prepaid items are assets like, say you pay your insurance a year ahead. You'd have an asset on your books called prepaid insurance. Well, you can't use that to pay bills because it's already earmarked for the insurance. So that's the idea. Anyway, so to figure out our quick ratio, we'll take our current assets. Actually, I'm going to put a parenthesis here and say total current assets minus our inventory divided by our current liabilities. We would expect the quick ratio to be smaller than the current ratio because it takes out those inventories, which were part of our current assets when we calculated the current ratio. Again, this is still a measure of how well we can pay our debts that are coming up. So there's the liquidity ratios that are covered in the book, and now let's take a look at the efficiency ratios. So the first is called our days in inventory, or sometimes it's called inventory days. The book calls it both of those, and it calls it DII. So on the numerator, we have our average inventory. So that means we have to take our inventory, we have to do an average of it. And on the denominator, we're going to have our cost of goods sold per day. Now this book uses a convention that some accountants use, that a day has 360, or I'm sorry, a year has 360 days in it. I know that sounds weird, but they started doing that years ago to make math easy. Every month has 30 days. Every year has 360. That is not really the convention now. A lot of more modern, because we're using computer systems and we can factor in all of those days, we'll go ahead and use a 365-day year. But just so you know, this book uses the 360-day year convention. All right, that's the way it does it. So to figure out our inventory days, we take our average inventory, which is going to be our inventory this year, plus, whoops, good thing for Control Z, we need to put this equals our inventory this year plus our inventory last year. Remember, these measurements are taken at the end of the year, so in essence, 2011's inventory would be December 31st, 2011, which would be the same as January 1st, 2012. So we're taking the measurement at the beginning of the period and the end of the period and dividing it by 2. That's going to give us our average inventory. If you're interested in how I'm doing this in Excel, then watch carefully. So that whole thing, which is last year's inventory plus this year's inventory divided by 2, and then we're going to divide that whole thing by our cost of goods sold divided by the number of days in a year, 360 in this book. And that's going to give us our inventory days of 74.17. What does that mean? It means, on average, our inventory stays in our business for 74.2 days. This is an average. In real life, one piece of inventory might sit on the shelf for years, and another piece might sell, we might sell it and replace it and sell it and replace it and sell it and replace it 20 times a month. So this is an average, the average number of days it takes us to sell an average dollar of inventory. Okay? So inventory turnover is related to that. We simply take 360, the number of days in a year, and divide it by our inventory days. This just tells us how many times on average we turn over our inventory in a year. So this business turns over inventory 4.85 times in a year. Again, this isn't speaking to any specific item of inventory. It's really speaking to a dollar amount equal to the average inventory. Okay? So really it's just saying, on average, we sell a dollar amount equal to our inventory every 74 days, or 4.85 times a year. Is that valuable? Sure it is, especially if you know how long it takes for your customers to pay you, or how long you have to pay your suppliers. There are many businesses that try to have a goal of 12 turns a year, or inventory, or a days in inventory of 30. That's a pretty tough thing to achieve. And what you're trying to do, again, is it good, is it bad, is you're comparing yourself against your competitors and against yourself in previous periods, and asking yourself, am I getting better or worse at this? It's a challenging thing, and those of you who work in the retail industry know, if you have too much inventory, you have money sitting on shelves that can't be used to pay employees, and it can't be used to reinvest in the company in other ways. If you have too little inventory, you've got angry customers. Every time I come in, you never have this thing you promised to have. So you're trying to keep just the right balance and keep just the right inventory turnover so that you're not wasting money by having it sitting there, and you're not upsetting customers by not having the things they need. Days sales outstanding. So this is our ending accounts receivable. So that's what's listed as our accounts receivable right here, 1312. Divided by our revenue per day. So divided by our sales revenue, divided by 360. So 54.36 are days sales outstanding. What does that mean? Again, what it means is, on average, it takes our people, our customers, 54.36 days to pay us. Is that good or is that bad? Well, I'll tell you without even comparing it, that's not good. If it's taking you nearly 2 months to get people to pay you, unless of course your payment terms are 2 months, you're giving people 60 days to pay and they're paying you in 54.3, then you're actually a little ahead of the curve. But typically people are shooting for more like a 30-day payment from their customers. All right, so days payable outstanding is how long it takes us on average to pay our debts, our payables. Okay, so again, this is calculated by taking our accounts payable and dividing that by our cost of goods sold. Remember, that's all the stuff we're buying and then selling again. Cost of goods sold per day. So here it's taking them 54.46 days to pay their suppliers. Again, is that good or is that bad? Well, it depends on your suppliers. Some suppliers might be fine with that. Maybe they have 60-day payment terms. Others might be screaming, and they're about to cut off doing business with you. In general, of course, we'd like to collect as quickly as we can and pay our suppliers as slowly as we can without alienating them. Right? If they're going to allow us 60 days to pay, then we'll push it right up to 60 days unless they give us some incentive, like a discount or something to pay off early. All right, property, plant, and equipment turnover. So our PP&E turnover is just our revenue divided by our property, plant, and equipment. So this is a kind of another way. Remember earlier we talked about how efficiently are we using our assets to create profit. Well, this is kind of similar. We're asking ourselves, how efficiently are we using our equipment that is specifically geared toward generating profit, our property, plant, and equipment? How efficiently are we using that to generate sales? Okay, that's what's meant by property, plant, and equipment turnover. And here it's 3.9. Meaning our revenue is 3.9 times greater than our property, plant, and equipment. What does that mean? Good or bad? Again, depends on what's norm for your business. Total asset turnover is just like it, except that instead of property, plant, and equipment, we take our total assets and we divide that. We take our revenue. I messed that up. Our revenue and divide that by our total assets. And there it's 1.67. So we're making sales 1.67 times greater than our total assets. That's what that means. Just quickly, typically a higher current ratio is better and a higher quick ratio is better. There is some point at which it becomes too big. That means you're leaving too many assets sitting there as liquid assets and not investing them. But generally speaking, higher is better. Inventory days, generally speaking there, that lower is better, right? We would like to keep our inventory sitting on the shelf less time. If we could sell all our inventory every day and do that just right so nobody was upset, then that would be awesome. An inventory turnover, that number higher is better. The more times we're turning our inventory over in a year, the better. If you think about the formula for it, if I brought my inventory days down to 30, then my inventory turnover would be 12. Days payable or days sales outstanding, again, lower is usually better. The faster I can collect on what my customers owe me, the better. Days payable outstanding, typically higher is better in the sense that we'd like to take as long as we can and leave our cash working for us before we pay somebody. But of course we want it to be manageable and we don't want to upset our suppliers. So I'd say higher is better with the caveat that if we're upsetting our suppliers by not paying them until 120 days, then that may not be such a good thing. So higher, except we want to keep them happy, whatever that number is. Property, plant, and equipment turnover. Again, what this means, the higher this number is, the more revenue we're generating for the same amount of property, plant, and equipment. So if my neighboring business that's just like mine, if they have to use $50,000 worth of assets to generate the same revenue that I'm generating with $30,000 worth of property, plant, and equipment assets, and that means I'm being more efficient. I'm generating the same amount of revenue, but with a lower investment. So Higher is typically better, and the same with total asset turnover. I hope that explains a little bit at least, and I hope it's valuable to you again. If you have any questions, don't hesitate to give me a call. Thanks very much and have a great week.